Welcome to Security Token Stories, brought to you by Security Token Academy, the leading educational platform dedicated to covering and facilitating the security token industry. I'm Derek Edward-Schloss, Director of Strategy at Security Token Academy. Coming up on today's episode, we have Marc Boiron, attorney and partner at law firm FisherBroyles. FisherBroyles is a cloud-based full-service law firm for the 21st century, with law offices in cities across the United States. Marc's legal practice includes the intersection of securities laws with blockchain-based digital assets. In today's episode, Marc and I talk through SEC Commissioner Hester Peirce's recent safe harbor proposal, which aims to remedy some of the issues the industry has seen in the application of securities laws to digital assets. We kick things off walking through a background on the different approaches blockchain networks have taken to bootstrap their networks over the last decade. We also evaluate the safe harbor itself and its proposed provisions. Finally, Marc works through the various pieces of feedback attorneys and builders in the space have provided over the last few weeks since the safe harbor proposal was announced and detailed. Marc is a terrific attorney and awesome thinker in the blockchain space. It's a great episode. I think you'll enjoy this one. Marc, welcome to Security Token Stories.
Hey, Derek. Thanks for having me.
Absolutely. Before we get started, can you just quickly introduce yourself, your background, your career over the last few years, and more recently, the work that you've been doing in the blockchain space over at FisherBroyles?
Sure. So I got started in the space in early 2017. Before that, most of my work was working on securities laws issues. I got interested in this space just because of the tech. And once I kind of jumped in, decided I'd focus my entire time on advising companies in the space. And so, that's been, a wide kind of range of issues, whether it's advising companies on token distributions or, funds that are being formed or, mining operations, just a wide range of work. Right now, one of the hot areas and an area I think a lot of work is popping up in right now is kind of the decentralized finance or open finance space. I've spent a lot of time there lately, which is fun, especially with some of the news that has been coming out recently.
Yeah, definitely. Well, you and I have, we've had some terrific conversations about some of the legal issues in both the crypto asset space and the security token space. And your practice is really kind of focused on the cutting edge of a lot of these issues. Today, we're going to dive in and talk about one of these issues, the SEC Commissioner Hester Peirce's recent safe harbor proposal, which has been making waves across the space. So I thought it would be helpful to split this conversation into three parts. The first part is just a quick background on blockchain networks over the last decade. The second part is walking through some of the points of the safe harbor and what it's really trying to achieve. And then the third is touching on some of the feedback Commissioner Peirce has received from the public over the last few weeks since the proposal was released. How does this sound?
Sounds perfect. Let's do it.
Awesome. Cool. So let's jump right into the current state of launching blockchains in the US. I feel like there's been a lot of lessons learned over the last decade as it relates to creating new blockchain networks. So, at first there was Bitcoin kind of in a category of its own. Later on, we started to kind of see projects fundraise with ICOs. And then the SEC jumped in and cracked down on a number of these unregistered offerings. We kind of saw the pendulum swing the other way to running regulated token sales. So I'm curious to hear from you. Can you talk a little bit about this history and how the space has evolved as it relates to bootstrapping networks? Just giving some high-level context and color about what it means to launch a blockchain network and what that's looked like over the last decade.
Yeah, so I mean, it's definitely changed a lot, right? So we started, a little over a decade ago with the Bitcoin network, and that was really simple. It was, the anonymous person, Satoshi Nakamoto or group, who, released the Bitcoin network, mined the Genesis block, and the rest is history there with Bitcoin. But the key thing being that you don't, I guess it's arguable, but you've never really had, other than at launch, you've never really had a central group that everyone can look at as being kind of the group that runs Bitcoin in any way whatsoever. And then we've kind of moved on from that, and we started kind of seeing the world of ICOs, and one of the first ones being Ethereum. And in those days, there's a lot of arguments as to what that, sale looked like. But we're very early days, and a lot of people who probably bought tokens in the Ethereum ICO probably did it out of interest more than out of investment purposes. I've definitely had conversations with people who do it who bought for investment purposes, and definitely many conversations with those who bought just because they were interested in what was happening and wanted to support it. And so when you think about it in that respect, there's a very different type of sale than what we will talk about. And so, since then, what we've seen is Ethereum kind of evolve, and here we are, more than 5 years after its launch, and we're at a point where there's still a lot of uncertainty as to what the Ethereum network's ultimately going to look like. And so after that, we kind of keep progressing. There's a time period where you saw a few ICOs, but it was slow until kind of 2017 hit, and really kind of early to probably middle 2017 was when kind of, I think everybody knows about the ICO mania. And you just had token sales all over the place. And, frankly, if you think about it from a technical perspective, it wasn't necessarily all that different from Ethereum in terms of how that actually was launched. But the messaging, I think, was very different at that time, and the approach to it was very different because essentially everybody was selling a token for the purpose of fundraising. And everyone who was buying it was purchasing it just because they wanted to make a bunch of money off of it. And that's probably with very few exceptions. There probably are some exceptions, but very few. So, we started having a change in the environment in late 2017 when we tried to kind of address some of the regulatory issues with SAFTs, simple agreements for future tokens. And, the intent there was to get around certain securities laws issues. But basically what we saw, and what really kind of slowed things down, in my opinion, with ICOs was the whole concept of the SEC delivering subpoenas to people who used SAFTs or other token sales. People kind of freaked out. And frankly, globally, it slowed down ICOs. And so ever since then, we've kind of seen a morphing of what's happened. After that, we saw a few what people would refer to as fair launches. And frankly, I think that was just happenstance in terms of timing. Grin probably being the most fair launch that you could probably see since Bitcoin, in my opinion. And then after that, we saw another uptick of activity, a little bit similar to an ICO in the terms of an IEO. And the general idea there was you're going to sell tokens, and you're going to do it by way of an exchange that is essentially going to vet the projects and then sell the tokens through the exchange. That didn't last that long. And essentially where we ended up is where we're at now, where we see another kind of big slowdown in token sales. And then we get Commissioner Peirce's kind of proposal relating to the safe harbor. I think the interesting thing that you see in common, basically starting from 2017, is you start seeing a whole lot less focus on the technology and a whole lot more focus on the money. And so while you've always had some projects that have been really focused on delivering good tech, you have had a lot of projects that really just focused on the money. And so I think that's kind of what we're seeing going away. And it looks like this proposal is trying to kind of bring that back, but in a cleaner way.
A super helpful historical walkthrough of kind of what we've seen over the last 10 years. I think it would be helpful to hear about the last few years specifically as projects started pre-selling tokens to launch these networks. It was very clear that securities laws were becoming implicated. And the industry started hearing a lot about things like investment contracts and the Howey test. So, Marc, maybe just as a background, to boil this down, what are investment contract securities? What is the Howey test? How have these legal concepts applied over the last few years to pre-sales of network tokens?
Sure. So we have what's referred to as the Securities Act of 1933, and so it's been around since then. And it has a laundry list of terms that defines what a security is. And one of those terms is intended to be a catch-all, that term being an investment contract. That term has been interpreted in many cases, with kind of the seminal case being, the Howey case, which resulted in the Howey test. And whether you look at it at 3 prongs or 4 prongs, there's several elements to this test. And essentially what it is that there needs to be an investment of money in a common enterprise with an expectation of profit derived predominantly on the efforts of others. And that predominantly on the efforts of others in Howey was solely, but that's also kind of further developed. And so it's been really very relevant in, any kind of token distribution. And especially in sales kind of pre-launch of any network, for the simple reason that there is no other term in the definition of security in which this could be caught up. And so you'd look at it under whether it's an investment contract. And I think what pretty much everyone knows is that everyone is giving some form of investment of money. That could be any form of value being given, whether that's dollars, some cryptocurrency, or services being provided. And so we can essentially assume there's always an investment of money. And then there's the question of whether there's a common enterprise when you're doing these sales. And you're going to hear a lot of arguments that there's not. So you see them in the Kick litigation. You also see them in the Telegram litigation. And you essentially have common enterprises that can exist in 2 different ways, principally. You've got what's referred to as vertical commonality in some circuits, and then you've got horizontal commonality in others. And essentially the simple way of thinking of them is one of them looks at the relationship between the actual issuer along with the buyers, and the other one looks at the relationship amongst the buyers. And so, generally speaking, in these token sales, you are going to have tokens that are distributed to buyers, and their profits and losses are going to go kind of up and down together. The fact that you can have a buyer who can choose to sell their investment before others, and so make more or less money because of that, isn't really part of the test. That's just a choice of when they choose to sell it. If everyone were to choose to sell at the same time, their profits and losses would be the same, and therefore there's generally going to be what's referred to as horizontal commonality. And so then we go to, is there going to be an expectation of profit? And if we combine that with, is there any kind of efforts of others? What you end up seeing is there's kind of 2 ways to think about how to eliminate that prong, and what people focus on to say it doesn't exist. So the first thing that people say is, well, there's no expectation of profit because people plan to actually use the token. And frankly, I think that in early 2017 was probably a good argument in the sense that we didn't know any better. And I mean, we as in really nobody knew any better. You had sales that were going on, and everybody thought that there was going to be use of these tokens, that inherently you're building something novel and people would come to it. I think very, very quickly, people should have realized it, and many did. There wasn't going to be actual use yet. From a user perspective, the technology is really not there yet. From a developer perspective, I think it's very different. And so unless your network is focused purely on developers using your tokens, which a lot of, kind of protocols, might actually be, that's not the case for, most other networks or dApps that were being built at the time. And so you kind of move away from that, although it's still a relevant portion, relevant kind of discussion, and it's kind of brought back by the safe harbor. But then you go to kind of the efforts of others prong, and that's really where I'd say most of the focus on kind of and discussion is today. I think most of that's been driven by Director Hinman. His discussion in his speech in, I think it must have been mid-2018, where he conveyed this concept of sufficiently decentralized. And it was in the context of Ethereum and basically saying, hey, that leaving aside the initial sale of Ether, which kind of implied it might have been a sale of a security, but definitely not certain. Right now, if you look at it, Ethereum is sufficiently decentralized so that those tokens are not considered to be securities. And essentially all that is essentially looking at the efforts of others prong and saying, well, are there really efforts of some of others as in a centralized kind of group? And yes, we have the Ethereum Foundation, but there's a lot more going on the Ethereum network than the Ethereum Foundation. And when you ask somebody, you say, where are you going to derive, profit? Where are you going to derive your profits from when you hold ETH? There's a certain portion of them that are going to be saying, well, Ethereum 2.0 is going to come out. And so, the Ethereum Foundation has a central role there. And so that's where we're looking to. But I think many others are going to say, I don't really know. I mean, I think the Ethereum Foundation's doing, some good stuff, but we've got tens of thousands, if not hundreds of thousands of developers building really interesting stuff on Ethereum. And I think all of that's really going to drive the price of Ether. And so what that kind of conveys is this idea of some broad group, none of which really has enough information to give to the ETH holders for them to make a decision regarding the investment. And suddenly it looks like, well, maybe we don't satisfy the efforts of others of Howey if we're sufficiently decentralized. And that's something else that we kind of see in the safe harbor.
I think that was a masterclass walkthrough of the initial token sale and this idea of with what does a sufficiently decentralized network look like to negate the initial implications of securities laws. So a few weeks ago, Commissioner Hester Peirce released the proposal to try and remedy some of the issues she was seeing in the application of securities laws with digital assets. Maybe just talk a little bit about her thesis, I think, with putting together this proposal.
Yeah. So, first thing I'll say is that, I think it's amazing that we got a proposal put forward by somebody like her. And, nothing I say is to take away from that because, I think a lot of people have criticized it. A lot of people recognize the amazing work that she's done and she has done amazing work. So I think kind of with that said, let's start with this general idea of she's a big fan of the technology. And she is concerned that the technology is moving kind of offshore in terms of kind of development and a lot of work done there. And in a lot of ways, that might be true, although in many ways, we're still seeing a lot of very good projects based in the US. And so she's basically looking at it as how do we keep this industry from moving offshore? And so I think, when she does that, she looks at this and says, okay, if securities laws apply to, pretty much all of these token sales, can we actually launch a network that is going to grow into something that is useful and that people in the US can benefit from? And to launch a network, I think one of the things she was probably told, and I'd agree with this, although some disagree, is that you need to find a way to get tokens in the hands of people other than just the initial developers. And so that was one of the things she was trying to solve for. And this makes sense. Why is it? First, we need comfort that anyone who's receiving tokens directly, from the protocol, whether it's miners or let's call them stakers, we need to know that the tokens they receive are not going to be securities. That's not really an issue here. It's not something that's discussed, but nonetheless, it's relevant. Second of all, we need to make sure that when users actually receive tokens, that they can then use them properly, and that nothing's going to kind of restrict their use. And then you've got the third, we want to also incentivize other developers to build on these networks. And so we need to, how are we going to do that in a network that is open source and makes no money? And none of these projects, frankly, make money. And most of them shouldn't make money from the network themselves. And so if you don't have cash, how do you pay people? And the answer has been, well, we'll find a way to get tokens in their hands. And we've seen some more creative ways to do that. And if you look at like Zcash, for example, than others. But the point being, we need to find a way to get tokens in their hands. And right now, it's been very creative ways that we've made that happen as an industry.
I think that's great. So let's dig into the specifics of the safe harbor. Something key to point out here. Before the safe harbor was proposed, if you wanted to sell a token before a network had launched, you had to either register the offering or qualify for an exemption. And we've seen the SEC affirm that stance a number of times over the last few years with blockchain networks, whether it's through settlements or speeches or actions. And one thing I found interesting with the safe harbor, Marc, was I think it appeared to say that even brand new initial token offerings could rely on this safe harbor carve out, which would exempt the offer and sale of tokens from the Securities Act and the Exchange Act for a specific time period. So, can you walk through exactly what the safe harbor is proposing, kind of what the time period that Commissioner Peirce is suggesting, and maybe just your initial opinions on kind of reading through this and some of the things that it implicates for you?
Yeah. To your point, she cites the Blockstack Reg A offering as an example of just the issues that all of this creates. And, there's multiple $1 million that Blockstack spent to be able to sell its tokens. And I mean, frankly, it's just not acceptable to need to spend that much as an early stage company to distribute network tokens. Not something that was clearly, just something that was to raise money, but would actually had intended to be used in the network. Maybe not by all the buyers, but it actually had usefulness to it. Regardless, her proposal essentially, the biggest point about it is it exempts any token sale from registration or needing to rely on an exemption. Actually, it makes it an exemption under the Securities Act. And so typically, when you are relying on an exemption under the Securities Act, it comes with a lot of restrictions along with it. Most of those are transfer restrictions, or they're substantial disclosures, or they're restrictions on dollar amounts that can be sold. But we really don't see that in a major way here. What we see is, okay, you're going to be exempt if you meet certain conditions. And so one of those is, hey, the initial team that's doing the development of this network needs to actually have the intention of creating a network where these tokens are being sold are going to be functional within what she basically says is 3 years. She calls it the network maturity. And within 3 years, you need to have reached network maturity. Obviously that 3 years is a completely arbitrary number. On top of that, if you look at, some of the more successful networks, and Ethereum's the easy example, we're much past 3 years right now. And I wouldn't say that, Ethereum, the Ethereum Foundation, or anyone who, was initially involved with Ethereum, thought that it would take this long, or that they've actually achieved what they thought they were going to achieve, back then. And so, 3 years is a very arbitrary time frame. It's pretty long, but when you're talking about creating a network that is intended to be used by a broad range of people, and then essentially nobody has control over it, to me, 3 years suddenly starts looking really short. Actually, it's not that long anymore. But given the framework that Commissioner Peirce decided to put out, it's essentially, she chose to pick kind of a date. Another thing that was kind of important is, on top of that, you need to make certain disclosures. Now, this is something that I've personally been harping on for a while, is this idea that we're supposed to register offerings or file a Form 1A and follow the disclosures required with traditional securities, when it really doesn't make any sense, is kind of problematic. And so, here we have she's kind of laid out, what it is that we'd have to see in terms of disclosures and things like your source code, transaction history, token economics, plans for development, things of that nature. I think one of the things that is underdeveloped in what she's put out is this concept of kind of governance during that time period. Now, partially it's because she views it as there's still a centralized entity that is intended to take certain actions, but token holders are at the whim of the centralized entity, and so they should probably have some kind of say, almost like a shareholder would of a corporation. And so that's something that wasn't focused on as much, but nonetheless, she talks about the disclosure requirements. Basically, then she says, the intent of when you do this, like your purpose is supposed to be the development of the network. Like that's what why you're selling these tokens. Again, that makes a lot of sense given her goal of, we want to make it possible to develop these networks. And that's literally the only reason. I also think that's something that's been underlooked by a lot of folks who've been commenting on it. I think you could go a little further in terms of restricting the language that she's used. But the fact that it's supposed to be sold for that purpose kind of indicates that maybe selling, millions of dollars worth to a VC isn't going to be compliant with the safe harbor, because it's not clear that, offering and selling that many tokens is for the purpose of development of the network. Now, that could also just be a question of language. Maybe the answer is, well, if you're just using the dollars to develop the network, then it very well could be, in which case it would be fine. And then the last point being that you have to file something. You do have to be relying on kind of the laws. You have to be complying with other laws, which makes a lot of sense. But on top of that, you have to develop a secondary market for the token. And this is probably the most controversial point, other than the 3 years of the whole thing. Because historically, if you go ahead, and it's been one of the things the SEC's pointed to frequently with respect to ICOs and other token sales, is you actually went and listed your token on an exchange. That clearly showed that people had an expectation of profit. Otherwise, you wouldn't have done it. And so now, this proposal says you're going to go ahead and actually list them on the secondary market. Now, I get why there's a lot of pushback on that. What I'd also say is that it achieves one of her goals, which is how do we get tokens into people's hands? But the corollary is, how do we let people actually monetize those? Because if you've got miners on network and you've got developers on network who are getting tons of tokens and they literally cannot do anything with them, I really don't know how many of them are going to stick around for very long. They need to be able to sell them, or they're not really going to be, able to live in the current economy that uses US dollars. And so, I understand the reasoning behind that. I'm not sure this is the best way to execute it, but it makes a lot of sense in terms of what she was trying to achieve. And so that's really kind of the kind of big aspects from a Securities Act perspective. I mean, there's, I guess some people would consider important that, essentially past projects could rely on this exemption under certain circumstances. But then the other part is that she actually goes into how to make kind of the secondary markets work. And she does it in a pretty brief way, which basically says that if you're going to be affecting transactions in tokens, which is what brokers need to do, or you're going to be, buying and selling tokens in a way that a dealer does, which is for their own account, or you'd meet the definition of an exchange, you're not going to actually fit into any of those definitions if you're dealing in tokens. And that essentially makes that secondary market possible in a way that it wouldn't otherwise. The one last thing she does that's really important is the Section 12G of the Exchange Act, which is essentially a way of making issuers become subject to reporting requirements after they reach certain thresholds of assets as well as equity holders. And what she says is essentially you're not going to fall into Section 12G. She excludes anyone who's offered and sold tokens. So that's kind of like the broad strokes of her safe harbor.
Yeah, that's great, and I think a very detailed step-by-step look of her thinking behind some of this stuff and how she put it together. I think this is a great time to jump into the third part of this episode, which is feedback we've seen from attorneys and builders in the space on the proposal so far. And one thing I have to say, Marc, before we jump in, is something I've noticed is how welcoming Commissioner Peirce has been about soliciting feedback at every step of the way. It started with the speech she gave in Chicago, releasing the proposal itself, the piece she recently wrote for CoinDesk, and public appearances since the proposal has gone out. She's been incredibly transparent about the evolution of her thinking around the safe harbor and the solicitation of feedback from professionals building or working in the space. I'm curious if you've noticed something similar and whether this approach feels typical or atypical for, I guess, a commissioner to kind of crowdsource thinking around these difficult issues.
Yeah, I'd call it very atypical. Crowdsourcing in a small group of people she knows, outside of the commission is typical. Crowdsourcing thoughts in the way that she is now, before any kind of concept released or proposed ruling is very, atypical, as in it's nothing official from the commission. But I'd also echo what you said. It's been, frankly, just amazing in that what she put something out and said, you know what, you guys might totally disagree with me. Go ahead and tell me. Don't hold back. And she's kind of been open to comment. She's publicly welcomed some of them. It's been really impressive, and frankly, the way she's listened to the community, I'd be surprised if we didn't see something very different from the proposal that we currently see when she kind of starts working through those comments.
Yeah, perfect segue into some of the feedback we've seen so far from people in the space. So I've gone through a number of the pieces, and I've tried to kind of distill down some of these main points that folks have brought up. And so I'll tick them off, and then I'd love to hear your thoughts on them. So the first one, the common denominator, is just it opens the door for potential abuse, and we may see an entire generation of networks potentially try and game this new system by pretending to be network tokens or raising money kind of fraudulently. I guess, what do you think about this first point, this opening up of potential abuse?
Look, I think any time where you lessen regulatory restrictions, you have that risk. I'd say that risk might be accentuated here, partially because of how I think easy it is to sell tokens in the first place, and how hard it is to actually monitor those sales. And so I do think it's a real risk. I don't think it necessarily has to be a risk of selling tokens, but I do think once you open it up in this way, where the only thing that's required is disclosure on a website, pretty much any website, about and then you file something with the SEC that doesn't necessarily give much information. At least I'm not expecting it to give much. You are opening it up to abuse, but the biggest issue here being you're not just opening it up to abuse with accredited investors, but with everybody. Retail investors as well. And now, so for those who think that, accredited investor rules shouldn't exist, they're going to be happy. For anyone else, the answer is, well, you're really putting retail investors at risk the same way they were during the ICO craze. And there's really nothing to hold the development team's feet to the fire during that 3-year period. And so that's probably one of the hardest things is, okay, so at the end of 3-year periods, you haven't actually done what you're supposed to. Now you need to register your tokens. Well, we've seen what happens when you try to have people register tokens that are already, out in the world. And I'm, referring to Paragon and, others like that. Where, they filed a Form 10 and essentially nothing's happened since then. And so, I think there's a lot of difficulty reining in trading of these tokens once it's out there. And I think this proposal kind of ignores that a little bit.
Another comment that I saw fairly frequently from folks that were responding, I think something I noticed was outside of fraud or abuse, a number of folks have said that the safe harbor is potentially incentivizing amateur or low quality projects to fundraise, especially those that may have a greater than high likelihood of failure. What do you think about this point, Marc? And while investor protection is a key driver for the SEC's mission, outside of fraud or direct abuse, should the SEC be stepping in and helping to better vet the quality of network projects, or should they really just let the capital markets appetite decide what they want to participate in or not?
So you implied something that was really important to actually point out, which is that, the anti-fraud provisions are not actually something that are going away. So fraudulent projects are 100% still something the SEC can go after. And so that's an important point. But beyond that, I think it's actually probably my biggest issue with the comments that I've seen so far is everyone is essentially saying, well, many folks are saying, these were terrible projects anyway. The tokens are horrible investments. And my view is, it's not the SEC's job to pick good investments versus bad investments. It's not their job in the traditional markets to do that either. They might vet them to ensure that disclosures are appropriate, but they're not, and they're still not going to approve those disclosures. But it's not their job to decide what is a good project or a bad project. And so what we've seen in crowdfunding in general has been, you have lower quality projects than what you're going to get going through some of the big VCs that fund tokens. I don't know that there's much to do about that. It still gives an opportunity to access certain good investments. And I think that's why it's so important to actually have the proper disclosures and protections up front, given that there are going to be a lot of bad projects. But I think the most important thing is bad projects are very different from fraud, and bad projects should be allowed to go try to raise money. Is I think Commissioner Peirce's point, and frankly, it's something where you see her diverge on a different issue, which is the whole kind of ETF point, where she's multiple times taken a position different from the other commissioners and saying, hey, we shouldn't actually be looking at the underlying the asset underlying the market. We should just be looking at the proposal itself. This is essentially my view. Her saying the same thing here is we shouldn't be looking at whether you think tokens are a good idea or a bad idea. We should just be regulating the disclosures and the documents themselves.
Very well said, Marc. Another I would say like maybe the third final piece of feedback I've seen are folks saying that the proposal itself doesn't really rely on a standard for decentralization, which has been one of the major points of confusion. That term, sufficient decentralization or sufficiently decentralized, that isn't really flushed out today. So in other words, the lack of a bright line rule for whether a network has reached a point of sufficient decentralization at the end of the 3-year period. What do you think about that?
Yeah, I mean, I'd agree with that. It's probably the weakest part of the safe harbor. For that, you need to look at the definition of network maturity. And it essentially says, it uses, first of all, the term, decentralized or functional network, two very unclear terms. But you've reached those when one of two things happens. And either it's that, the network is not controlled or reasonably likely to be controlled by a single person, entity, or group. And so that's going to be the case. I think oftentimes that could be the case, but you could still have a central group that is driving value into the token, even if it doesn't actually control the network itself. But when it is that they're considered to control it or not, that's really hard to tell. The second part of that being it's considered to be functional. And functional is probably a term that I'd say popped up first in the context of the SAFT. Basically saying, hey, you've pre-sold tokens. Once the network becomes functional, you can actually deliver those tokens. I personally don't think functionality goes very far. I mean, it's easy to have a functional network. And here, the proposal specifically says, it's demonstrated by the ability of holders to use tokens for the transmission or storage of value, to prove control of the tokens, to participate in an application running on the network, or in a manner consistent with the utility of the network. Bottom line being, it's if the network exists, it's functional, and that just that's I think we've had enough history now with networks to know that just because a network is functional does not mean there are no more efforts of others. And that's essentially right what she's trying to get at here with network maturity is there's no more efforts of others. And I don't think we get frankly even close to not having efforts of others with just a functional network.
Yeah, that's a great point. Okay, wrapping up, Marc, final question, kind of zooming out, what do you think the likelihood is that the safe harbor moves forward in some form? And this is more, I suppose, a political question than a legal question. At some point in the future, is this thing not likely to move forward? I guess, how are you thinking about this, the safe harbor as it exists today, 2 weeks after it's been proposed?
I mean, I think the first part in terms of it actually moving forward as a proposed rule, one thing we have to keep in mind is that Commissioner Peirce's term is up in, I think, June of this year. She could still stay on for, I believe, another 18 months if nobody fills her chair. And so, if somebody does, then she's not going to be around after June. And so, while it doesn't seem likely that she'll be gone in June, if it's shortly thereafter, there's probably not going to be enough time for this to actually move forward. And obviously, it requires a proponent like her to make that happen. But leaving that issue aside, I think we can separate this into three different issues, the safe harbor. I think there's the issue of the initial sale of the token. Then there's the issue of when does the token not become a security? Then there's there's the issue of kind of secondary market participants and intermediaries, right? And if we look at the kind of the initial portion of that, the token sale itself, I'm guessing that we end up with something that looks like a hybrid between Reg CF and Reg A. Think of it as kind of Reg CF in terms of disclosure, so lighter disclosure, but the disclosure is going to match what we see in the safe harbor in terms of type of disclosures. And but then you're not going to have the tokens be restricted securities the way they would be under Reg CF. And so I think you're going to have, there's a possibility that you still have a secondary market for the tokens, but you have somewhat more of a process involved in the initial sale than what we're talking about here. So I think that's one possibility. Other than that, frankly, anything less than that, in my view, is just not going to fly. Right? She needs to get the other commissioners on board. I'm sure this was discussed before she put it out there, but this just seems really, really light on the front end for something that ends up in retail investors' hands. Then I think in terms of that transition from security to non-security, I'd be really surprised if we end up seeing a fixed date. I think her attempt to put a fixed date was to create some kind of certainty, but that fixed date really just triggered a test that is still uncertain. I think we're going to get a test that is going to be more certain, and it's going to be more tied to percentages related to ownership of tokens, use of the network, or transactions on the network. There's going to be something a lot more definite, and I think that should create a bright line. I don't think it's very useful to create anything other than a bright line, because you get into the exact same situation you're in now. You're like, ooh, when can I actually start treating these as non-securities, to the extent you believe in kind of the mutability concept that's been floated around now. So I think that's the second part. Then you've got the third part of, how are these going to trade? I think when they are, post securities, I think it's more obvious. When they're still securities, so pre, which uses as network maturity, where should these be able to trade? My view is putting them on a non-securities exchange, the way that's proposed right now. I think that goes kind of a step too far. I also think that putting them on a kind of traditional securities exchange or alternative trading system, really where we're at in terms of development of that technology, and from a regulatory perspective in terms of who you need to get approvals from, I don't think that really is useful in the near term in any way whatsoever. And so I think that kind of leaves us with what other alternatives there are. And I think it goes with this concept of decentralization. And what you start looking at is what options are there where there is no intermediary. And for that reason, there really shouldn't be securities laws applying. And so, the thing that comes to mind is decentralized exchanges. And in the last, if you go back 2-3 years ago, the decentralized exchanges were brutal, not very useful. If you look at them now, there's a few pretty solid decentralized exchanges where you're starting to see a lot more volume. And those are only going to get better. Are they going to be as good in terms of volume and experience as centralized exchanges? No. Will they be able to give the liquidity that developers and miners need? Yeah, probably, or at least close to what you need. And those frankly maybe shouldn't invoke the securities laws right now, but having some kind of safe harbor that makes it clear that those type of exchanges with no real intermediary don't create securities laws issues is important. Now, in doing that, there's a lot of other relevant issues that come with it, in that, a lot of DEXs, if you look at how they're actually structured, they've got liquidity pools and they've got tokens themselves. And so you need to kind of work through those issues. But leaving that aside, I think that if you actually look at letting them trade on exchanges that don't actually have intermediaries, is probably the way to go. Whether the commission is at a point where, and I don't mean this in a negative way, but is forward thinking enough to say we're okay with DEXs, I'm not sure. I tend to lean towards no, but my hope is yes.
Marc, as always, I really enjoyed talking with you about these tough legal issues and how you're thinking about the space. Where can people learn more about you and FisherBroyles, the work you're doing, and how can folks find you and reach out to you if they'd like to learn more?
So I'm active on social media. So you can go to LinkedIn, just type in Marc Boiron, it's Boiron. On Twitter, I'm a Boiron attorney. And then you can find me at FisherBroyles.com.
Awesome. Well, thanks for joining me, Marc.
It was a pleasure. Thanks, Derek.
That's it for this week's episode of Security Token Stories. For more security token content, visit us online at securitytokenacademy.com and subscribe to our newsletter, The Security Token Edge, which lands in your mailbox each weekend. You can also keep up with the latest security token news by following us on Twitter, Telegram, YouTube, Facebook, and Medium. Before we go, a big thank you to Security Token Academy's Platinum and Gold corporate members who make this podcast possible. You can learn more about Security Token Academy's corporate members at securitytokenacademy.com. I'm Derek Edward Schloss. From all of us here at Security Token Academy, thanks for listening.
Security Token Academy does not provide investment or legal advice. We are not a registered broker-dealer or investment advisor. Opinions expressed in this podcast are the speaker's own and do not necessarily reflect the views of Security Token Academy. More information can be found on our website at securitytokenacademy.com.